And in March, we actually saw the Treasury market briefly break. So if anyone was paying attention very closely to the Treasury market, when we had this big, when we had the news out of China about shutdowns and the virus is spreading, you started to see certain things sell off first. You saw commodities sell off. So you saw copper and oil start to go down because they're very sensitive to, their demand and economy. And then you also saw the bond market start to rally. So yields were coming down because the bond market was correctly anticipating a deflationary shock about to happen. However, when we got that big sell-off in March, so we started to see, bond yields kept going down, equity started falling. But during that kind of mid to late March period, it got so bad. We started to see the dollar spike relative to other currencies, and so we actually saw a lot of forced selling of treasuries. So we had the foreign sector selling treasuries, we had risk parity funds selling treasuries, and so the yields actually started to spike in mid-March. But then actually more concerning than that is that the actual liquidity in the treasury market dried up. So bid-ask spreads became unusually wide, and that's supposed to be like the most liquid market in the world. And so the Fed had to come in and buy $1 trillion worth of treasuries in 3 weeks.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a first-time guest who was insistently requested by our subscribers. This is Lyn Alden, an analyst and founder of lynalden.com. She joins us this Wednesday, December 2nd, 2020. Lyn, thank you for coming on the channel.
Hey, thanks for having me. Great to be here.
I was introduced to your work by our subscribers and have seen some of the interviews that you've done in various financial channels around, including in mainstream media as well as alternative media and independent and at financial conferences, etc. So you've got a very broad exposure and quite a high reputation. The number of comments and, questions that were submitted by our viewers ahead of your arrival here was so numerous that we'll have to be very selective in the ones that we treat together. But I guess if you could just kick us off with just a couple-minute understanding of your background, how you got into financial analysis, and then we'll ask you about your biggest takeaways of our current financial environment that we find ourselves in before we get into some viewers' questions.
Yeah, sure. So my background is a blend of engineering and finance. I've been investing ever since I was very young, actually before I was an engineer. But when it came time to go to school, I ended up going down the engineering route instead. So I went through that curriculum, and then I became an electrical engineer. And then I got a master's in engineering management, so that was more financial focused. And so I kind of shifted more towards engineering management. But on the side, throughout that whole process, I also, I started out, like a decade ago with like a small investing blog. But then in late 2016, I founded Lyn Alden Investment Strategy. So it's a more concerted effort towards using some of the quantitative background I've established to apply that to financial markets to figure out what asset classes or individual investments likely offer good returns. And kind of my approach is to have like a fundamental oriented approach, but then have a global macro overlay. So I have the big picture, the background, whenever I'm kind of looking at an individual investment.
Perfect. Okay, so could you take us, maybe let's spend a couple minutes on each of those two main focuses, but let's start with the global macroeconomic background first, and then we'll talk about some of the fundamental analysis that you've been most recently doing. So let's talk to us about the environment we find ourselves in first.
Yeah, so probably the biggest picture thing I'm looking at is the long-term debt cycle. And so that was a topic that was popularized by Ray Dalio, the founder of Bridgewater. And it's something that, after I saw his work on that years ago, I put a lot of research into it as well. So I kind of fleshed that out and kind of tackled that from multiple angles. And the idea with the long-term debt cycle is that, we're all familiar with the business cycle, like the 5 to 10 year boom bust thing that we experience in most healthy markets. And so, in any sort of private sector, you get more and more deleveraging as things go on. But then, there's either an external issue or an external shock, and something happens that triggers a deleveraging and a recession. But in the system that we operate in, policymakers come in and they cut interest rates and they do fiscal stimulus. And so that deleveraging never goes all the way down. So instead of deleveraging back to your starting point in the cycle, you deleverage maybe half the way, and then you quickly start building up from there.
Just so I can make sure that I and our viewers are all on the same page, and maybe it's just for my benefit, this whole deleveraging we're talking about is basically what other people talk about, sort of like the forces of nature, the natural cleansing process of burning out the dead wood, bad businesses going bankrupt, and so you can start fresh and have healthy things grow back.
Exactly. And the most visual way to look at it, I've shown charts, for example, corporate debt as a percentage of GDP. Basically, you have that deleveraging event. Some weaker companies go out of business, other ones get restructured, and you start building up from there. But they kind of short circuit that full process because it's a very painful event. And so instead of deleveraging all the way, they deleverage part of the way, and then they start building up leverage again. And what happens when you string multiple of those business cycles together is you get lower and lower interest rates and higher debt levels. And so even though you have highs and lows, you keep having higher highs for debt and lower lows for interest rates. And that party kind of stops once you hit zero, because it's very hard for them to reduce interest rates far below zero. Now, some countries have experimented with negative 0.5%, but you can't just keep going deeper and deeper because eventually people pull their cash out of banks, and basically the whole financial system's kind of created to run on positive interest rates. And so when they hit the zero bound, they shift to different tools. And historically, that is asset purchases and larger fiscal deficits that they end up monetizing. And so historically, in the last time we were in this situation where you had a long-term debt cycle crash into the zero bound was the 1930s. And so I've done a lot of work basically showing how the 2010s in many ways mirrored the 1930s in terms of monetary and fiscal policy, and the 2020s are shaping up to look a lot like the 1940s, which was a more inflationary and deficit-heavy environment, whereas the 1930s was more of a banking crisis and stagnation environment.
In that last topic, we've had Alistair McLeod from goldmoney.com on talking about, in his view, he sees extreme risk. He says we're just at an extreme risk level of at least banking and credit crisis, and possibly also a fiat currency crisis. Could you give us your weigh in on those potentials and how what risk level you see that we're at in both a banking and credit crisis as well as fiat crisis potentials?
It partially depends on where you are in the world. So I think the European banking system is more concerning because they have their own kind of unique issues. In the United States and many other countries, I'm less concerned about a banking crisis itself because going into the 2007-2008 crisis, banks were highly leveraged. So the percentage of their assets that consisted of, say, cash or treasuries was unusually low. And their percentage of assets into, real estate investing and that whole bubble that was, part of that was very high. So, when they were that highly leveraged and then you have a default event, many of them became insolvent. Technically, the whole industry was at risk of insolvency. And that's actually very similar to what we saw in the 1930s. And so both of those instances had this big, bailout recapitalization thing. Now, due to kind of the past 10 years or so, now banks actually have the opposite scenario where they actually are holding more cash and more treasuries as a percentage of their assets than they have for the most time in the past several decades. And so in many ways, there's individual banks that are more problematic than others, but it's not the banking system was the kind of the core of the issue, over 10 years ago, whereas now it's the fact that their clients are suffering. So banks, by extension, are accumulating some loan losses, but they're much better capitalized going into this one than they were last time. So it's more about the broader economy that I'm worried about. But for the second point about the currency, I do think that's worth more of a risk because historically, when you get to the zero bound and when you have debt levels this high, usually you get some sort of currency devaluation event. That's really what separates the end of a long-term debt cycle from the end of a normal business cycle, is that usually you have some massive shift in fiscal and monetary policy that usually results in a currency devaluation. So in the 1930s, of course, you had the reduction of the gold peg. And then you had in the 1940s, you had financial repression. So you had multiple years of double-digit inflation. But instead of being like the 70s where you had sustained inflation, in the 40s you had these kind of intermittent shocks of double-digit inflation. But the Federal Reserve held Treasury yields at 2.5% or less, using the power of their balance sheet to basically print money and buy treasuries. And so what that did was that held real yields negative. So anyone who held treasuries or had money in a bank, you didn't lose your money. You got all your money back nominally, but you lost out on purchasing power. And so that's shaping up to probably look a lot like that in the 2020s, where people will get their money back, but that money will be worth less and less over the course of the decade. And whether or not that happens fast or slow, I think there's a lot of kind of variability there. But I think one of the higher conviction things is that real rates are likely to be negative for quite some time.
It's so concerning. One of my main concerns about that, actually, for the benefit of ordinary people, is that they might not understand the impact of that on the individual and the individual family and on small businesses, that sort of thing. Okay, so if we could shift from the macro picture to the fundamental value analysis, you've already kind of given us a warning sign about the fundamentals of the currency, which kind of in some ways is a measure of everything else. But from a valuation and a fundamental standpoint, what are you looking at right now that gives you the most concern?
Well, I mean, so if you look at different markets, there's different, there's equities, there's commodities, there's the bond market. So the most concerning areas to me are the bond market, the currency, mainly because of the currency itself, along with their super low yields, as well as some of the highest value equities. So because interest rates are so low, investors have basically reduced their discounted cash flow rates. So they bid up the valuations of these growth stocks to extraordinarily high levels. And we've seen similar things in of course, the well-known late 90s tech bubble, but also back in the late 1960s as well. So there's a precedent for this level of kind of euphoria in growth-oriented stocks. And what tends to happen, of course, is they end up not doing very well over the next decade. So if you go back to those periods in history, like the 1960s, for example, that we had the concept of the Nifty 50. So it was like 50 stocks you could buy that you couldn't go wrong. It was companies like Disney and Coca-Cola and things like that. And the vast majority of them did very well over the next 10, 15 years, but their stocks didn't, because even though their earnings and revenues kept going up, those stocks were so highly priced in the 1960s. And when they encountered the 70s and there's more inflation and people demanded higher earnings yields on their investments, those valuations came down. So even though the fundamentals did fine, the investments were pretty poor from the perspective of those high valuation levels. So I'm concerned about some of these growth-oriented equities. I think there's more opportunity in some higher quality value stocks, as well as some international stocks. And then also, I think the commodity space is pretty interesting.
Well, we want to talk. There's a lot of the questions that have been submitted for you have to do with the commodity space, so we'll get there in a little bit. One more question is that we haven't touched on yet. You did touch on policy interference with the cycles of nature, as far as artificially low interest rates, artificial asset purchases by central banks, that sort of thing. Could you talk to us about the really big picture of interference on policy, how it's going to affect our current year and the future, our near-term future? There's a question on that specifically from a viewer named 49Fine, who, after congratulating us for getting you on the show, says, what is your take on Klaus Schwab, the founder of the World Economic Forum, along with his globalist cohorts pushing their, quote, global reset and fourth industrial revolution? Seems to me a reset into total communism, with modern monetary theory being the carrot that corrals the masses of the sheeple into the slaughterhouse, professing that this is the only way out of the global pandemic we're all forced into.
Yeah, so I actually have an article coming out about this soon, but basically, the idea of a great reset refers to, it can refer to the long-term debt cycle, but can also refer to the global monetary system. So the last time that shifted was the early 70s, and the time before that was 1944 with the Bretton Woods system. And so usually those transitions are also accompanied by a currency devaluation, similar to the end of a long-term debt cycle. And I think there are a lot of signs pointing to the fact that the current one, as structured, is getting really strained around the edges. And they've already openly talked about things like a new Bretton Woods system and things like that. I think the thing that they're running into, though, however, is that if you look back, for example, at the actual Bretton Woods, that was towards the end of World War II. The United States was emerging as the decisive winner. The United States share of global GDP was roughly 40% due to the devastation that many other major markets experienced. And so basically that was kind of an environment where they could centralize power to such a degree that they could have a unified kind of lock on what monetary policy is going to look like for the next 2.5 decades. But now the global environment's a lot more fractured. So I think what a lot of those people that have a more centralist view of how things are going to work out are probably going to run into headwinds because China wants to do their thing. Europe wants to do their thing. The United States wants to do their thing. And I think we're probably going to see some more decentralized solutions going forward. We're already starting to see, for example, that for the past several decades, most global energy pricing has happened in dollars. That's been a key part of the petrodollar system that was established in the 1970s. But that's actually starting to fray around the edges. So we see, for example, Russia made the active decision to begin selling more of their oil in euros. And so whereas other countries have tried that in the past and it hasn't worked out well for them, Russia has a lot more clout that they're able to push that, especially when they have partners like China. They're also willing to go along with that. So I think my kind of base case in the 2020s is for a more decentralized system in some ways, rather than kind of the centralized system that some of them might attempt.
You were mentioning about currency strength and the global reserve currency. Menachem Saler says, Lyn, why do precious metals generally move inversely to the U.S. dollar index if the index is a measure of strength relative to other fiat currencies?
So one thing I've shown is that in many ways it does not move inverse to that. So you can basically at any given time frame, gold can be correlated to one thing or another. So you could have periods where the dollar and gold go up together. You could have periods where they go down together. The longest term correlation with gold is real interest rates. So that for the purpose of conversation, that would be the 10-year Treasury nominal rate minus the inflation rate. And because gold is heavily moved by the big money markets, they use official CPI or inflation break-evens as their measure of inflation, whether it's right or wrong. That's often what it correlates to. And so what you see over the long run is that gold tends to move inversely with real rates. And so say inflation is 2% as officially measured, and Treasury yields pay you 4%. That means you're getting a 2% yield above the inflation rate, and therefore assuming those measurements are reasonably accurate, you're retaining your purchasing power, possibly growing your purchasing power, and therefore the opportunity cost of holding a yieldless asset like gold is less attractive. Especially when you count storage costs, fees. However, say inflation is still 2%, but the Treasury yield is only yielding 1%. Then suddenly your real interest rate on those treasuries is negative 1%. And suddenly that yieldless, scarce asset that keeps up with inflation over time looks a lot more attractive. And then if you add on to the fact that CPI is probably higher than is officially stated, because if you look also, gold has generally kept pace with the broad money supply per capita over the past several decades, but it fluctuates around that trend with real interest rates. And so that's one of the key correlates for the gold price, more so than things like the dollar versus other currencies and things like that. The only kind of connection it has to the dollar index is that a lot of gold pricing happens to happen in dollars. And so when you have a much weaker dollar versus some other currencies, those periods tend to be pretty decent for gold, but it's not as strong of a correlation as with real yields.
You mentioned before about the time of post-World War II, or near the end of World War II, when basically the U.S. was the only one that still had an intact manufacturing base. Really, everyone else had been so damaged by the conflict of World War II. And you mentioned that now the global economy is more, you said, fractured. So there's activity and there's lack of centralization in real financial power or economic power, maybe going forward compared to the past. What's your view of the global economy going forward, coming out of this global shutdown and all that's gone with it? How do you see the macro factors, whether it's new technology being a plus and some of these policy lockdowns being a minus and whatever else, perhaps overvaluation of markets having a drag on the ability of companies to effectively borrow so they can grow and so on in the future? What's your view of the look forward on the global economy?
Well, unfortunately, what we've been seeing this year is a big decoupling between larger and smaller companies. So, for example, if you run a small family-owned restaurant, a lot of those went bankrupt or just decided to close their doors because they decided that they didn't have enough cash and enough resources to get through this period of really weak customer traffic, even with things like delivery and stuff, because that doesn't their margins aren't as good with that. And however, the corporate restaurant chains, for example, they have access to better financing, they have access to bond markets, they have access to all sorts of kind of a cheaper cost of capital, and many of them have been able to push through this. And so we see, for example, if you look at small business revenue, that kind of partially recovered into the summer, but then kind of flatlined and started rolling over, whereas larger businesses have somewhat done better. So that's one of the most concerning trends I'm watching is kind of that centralization of power more towards the top end of the corporate stack, because they're the ones that are most connected to either financial markets or to bailouts like the Fed or fiscal bailouts and things like that. So that's one of the things I'm kind of most concerned about is that kind of K-shaped recovery as it's been called. And so I think by when you look at late 2021, so let's say at least 6 months from now, I think behavior from people could start to return more and more towards normal. We'll see how the vaccines affect people's perception of how safe they feel to go to restaurants or fly, whatever the case may be in different countries. But I think even if you look at the Spanish flu of a century ago, after about a year, 18 months, I mean, most things, behavior started to really kind of normalize. But because there's so much debt in the system and so much, where we are in the long-term debt cycle, I think it's going to be somewhat of an inflationary kind of trend change. And so I'm not looking towards super high inflation right away, but I think as we go deeper and deeper into the 2020s, that inflation is possibly going to rear its head. And so I'm kind of looking more towards a value over growth shift. So, value equities doing a little bit better than growth equities, and some of these harder assets likely doing pretty well, especially when measured in currency units that are, expanding at a pretty rapid rate due to, money supply going up rapidly and interest rates remaining very low, especially because I think that the Fed is going to do financial repression and continue to prevent yields from increasing at a pace that would compensate for the inflation that occurs.
Yeah, I really would appreciate if you could show us or explain to us some of more what you see as the consequences or the impacts of these likely policy or likely economic factors, like you mentioned, large business versus small business, on ordinary people. What about unemployment? What about the ability of small-time landlords to be able to get their rent payments? There's Verbo owners or Airbnb owners, or there's just small apartment owners, that sort of thing. It's what do you see this hitting ordinary people? And then do you see any like a cliff event, which the strain just gets too great in the system and it can't tolerate it? Because you talked us into the 20s, so how long do you see sort of just painful but ordinary pain increasing versus do you see something kind of catastrophic having to come from this because the strain can't be borne by the system?
Yeah, so a concept that I've been emphasizing since April is the idea of like a backward square root sign recovery. So if you picture that, you have like the economy's doing it, like jobs are doing its thing, and then there's a big fall that we had in March, and then so my view at the time back in April was we'd have a quick partial V-shaped recovery, but instead of going all the way back to the top, it would then roll over and start to go up at a slower rate. And so that's what we've seen so far happen since then, which is we had that quick rebound from the hardcore shutdowns, right? So we had restaurants partially reopen. So we got that kind of snap back in some of the extreme job losses. However, it didn't snap back anywhere near to the previous high. And so that's going back up at roughly the rate that it was going up before the pandemic, except from a much lower base. So at the current rate, it would take years to get the full amount of jobs back that was lost. And so I expect that to continue to still take a while to get those jobs back. And in addition, just where we are in the cycle, if you look back at the long-term debt cycle from before, you tend to see rising periods of populism. And we've been seeing that over the past several years, not just during this pandemic, but in the past several years, where people sense that something is wrong. But they whether or not, because populism emerges on the right and the left, so people have different conceptions of what the root cause is or what the solution is. But the general thread that they all share is that there's something wrong with the system. They're not sure what it is, and then you tie in social aspects and economic aspects, and it has different identities across the political spectrum. But you tend to see that kind of populist versus establishment shift, and so we saw that kind of hit ahead earlier this year, with some of the social movements and some of the protests, and then some of them diverged into riots. And so I think that those are risks that are potentially going to keep happening in the 2020s. Now, I think some of the decision points would be to watch what happens with stimulus, because if you look at this year, So in a normal recession, personal incomes on a national scale go down, and they take a little while to recover. Personal income nationwide actually went up this year. And that's because, so people lost money with wages on average, but then they got stimulus checks, they got, $600 a week in unemployment benefits above and beyond the normal state ones they normally get. And so you had that kind of spike in personal income. And so many of them, were made whole in that sense. But of course, that wasn't paid for by anything other than increasing the monetary base. So you basically spread out those dollars. And so I think that, as we go deeper into the 2020s, we have to watch to see what kind of fiscal policies happen. Because I think, as you get rising populism, you can get those larger deficits because people kind of demand, certain things, and then they don't want to pay the taxes for them. And so you get that, that stimulus environment, but then you also get some degree of currency devaluation or inflation along with that. And so, one thing we saw from the 40s and the 70s is that, those were periods of high inflation over the past decade. Those were the two inflationary decades. And in some ways, you saw a reduction actually in wealth concentration during those periods, but it came at the cost of the currency to some extent. You basically saw a shift to some extent in political power, and you saw people that have more debts kind of get bailed out, whereas people that have a lot of bonds, have a lot of cash, they're the ones that tend to take that hit.
Several times you've come back to that specter of currency devaluation. I guess I'll go ahead and tie in this viewer's question in that vein. GrooveJet77 says, with so many ticking time bombs, which one do you think will go off first? The repo market, student credit loans, credit cards, bond market collapse when nobody shows up to buy the trillions of dollars needed to keep the Ponzi scheme going?
So actually, the funny thing is we saw some of those break over the past year. So if you look at September of 2019, we saw the repo market break. And so the Fed had to come in and bail that out. And so they had to start lending repo loans, and then they had to shift to buying treasuries. And then in March, we actually saw the treasury market briefly break. So if anyone was paying attention very closely to the treasury market, when we had this big, when we had the news out of China about shutdowns and that the virus is spreading, you started to see certain things sell off first. You saw commodities sell off. So you saw copper and oil start to go down because they're very sensitive to their demand and economy. And then you also saw the bond market start to rally. So yields were coming down because the bond market was correctly anticipating a deflationary shock about to happen. However, when we got that big sell-off in March, so we started to see, bond yields kept going down, equity started falling. But during that kind of mid to late March period, it got so bad, we started to see the dollar spike relative to other currencies. And so we actually saw a lot of forced selling of treasuries. So we had the foreign sector selling treasuries. We had risk parity funds selling treasuries. And so the yields actually started to spike in mid-March. But then actually more concerning than that is that the actual liquidity in the treasury market dried up. So bid-ask spreads became unusually wide. And that's supposed to be like the most liquid market in the world.
Mm-hmm.
And so the Fed had to come in and buy $1 trillion worth of treasuries in 3 weeks. And so that was basically the big shift where, we shifted more aggressively towards indirect deficit monetization because they're not buying from the treasury directly at auction, but they're buying through the commercial banking system and basically taking all that excess supply off the market by creating new dollars to do it. And so I'd actually say we've already passed some of those breaking points. And that's why, for example, if you look back at the 1940s, that was the only other time in history where U.S. debt to GDP was as high as it is now. And so back then, it was also that the Fed ended up being a very large buyer of those treasuries, along with the commercial banking system. So I think we're probably going to see that again in the 2020s, where the Fed and the commercial banking system end up owning a larger and larger share of the treasury market, whereas the foreign, sources are not really buying too much. And we have things like pensions and other sort of domestic buyers that also aren't buying very aggressively. So I think we're going to see more and more of that end up on the Fed balance sheet and the commercial banking system. I think one of the biggest shocks we could have is if the Fed decided to do formal yield curve control like they did in the 1940s. So the Fed actually started talking about yield curve control in 2019. So that was before the pandemic. And we've seen Japan and Australia do very minor versions of yield curve control. And the Fed in recent months has cited those examples. They also cited the 1940s. And they kind of put it on the back burner for now. So I think they're not trying to spook the bond market too much. But I think going forward, if yields rise above a certain point, the Fed is probably going to do some degree of yield curve control where they keep yields low, and the release valve for that can be the currency, it can be commodity prices, and things like that. Because if market forces can't show up in one market, they instead spill over into another market.
So when you talk about the Fed buying up one thing after another, you've gone down the list, and it just seems to be going on. What happens? What's the end game of that when the Fed becomes the buyer of everything?
So it depends. If you look at what happened in the 40s, after the war was over and after you had that kind of period of stability, they shifted more towards financial austerity for several years. And so what they did was they held the debt flat roughly. So you never paid back that federal debt, but they held it flat. And then nominal GDP kind of caught up to those debt levels. So you deleverage debt to GDP that way. In addition to, of course, what I point out in the 40s, which was you inflated a big chunk of that away. So you lost about a third of your purchasing power if you were holding treasuries for the full 1940s decade. So in general, what you'd probably see is a devaluation of that debt in purchasing power terms as nominal GDP, over time catches up. Now, the harder part this time is due to demographics. A lot of their deficits are more structural. And so we started to see the deficit rising from 2016 to 2019. So it was before the pandemic. And that's very unusual during an economic expansion. Normally, you still see deficits during an economic expansion, but they're usually at least shrinking as a percentage of GDP until you have the recession come and you see tax revenues fall and you see spending go up. Whereas this time, even during the expansion, you were already seeing a ballooning deficit. And that was in large part due to the baby boomers shifting more and more towards retirement and drawing on some of those systems. So we see, for example, Social Security is more and more top heavy than it was 20 years ago, 40 years ago. And we also see things like Medicare pretty top heavy. And so that kind of structural entitlement system, has pretty big deficits in place. So I think it's going to be really interesting in the 2020s as they kind of try to thread this needle.
I'm not even sure how much of a needle it is, because it's with some of these mega trends like demographic winter and so on that you're describing it's not like you just got to adjust something to hit a target, because it's just shifting and it's not coming back. Do you see any, because again, when you talked about how you right the ship after you've gone too far negative on policy rates, that sort of thing, and then you have to. They tried right in 2019 to try to normalize the Fed's balance sheet. How do you normalize from the place that we're heading right now?
So I don't see it normalizing for a while. If you look again in the history, it's not that the central bank balance sheet ever went down; it's that they managed to have it stop going up enough that eventually, as a percentage of GDP, it went down simply by not going up anymore for a while. And so, basically, what I would expect is that this whole 2020s decade is going to be a process, probably involving currency devaluation, where once they basically inflate part of the debt away, it's possible that they could right the ship and kind of fix the budget in such a way that they can get back to some sort of sustainability going forward. But we're gonna have to see what happens at that time, because trying to predict that in advance is basically trying to predict political behavior.
Mm-hmm.
So that's not really something you can look at the numbers and say this is what's going to happen. You can look at the numbers and say this is the problem. Here's kind of a mathematical inevitability. But once we're kind of in that and it's happening, then the question is, what do they do? What do policymakers do? And I think that's going to be a key thing to watch. And I think there's ways to defend against it, because it can take multiple different forms. But whatever form it takes, there are certain things, especially if you have some degree of diversification, they can hold up very well in a multitude of different environments.
You mentioned a little bit earlier about the commodities that were impacted back in earlier this year. For example, you mentioned copper. There was a question from Luke V about that. What do you make of how copper has been performing given the market conditions these last few months? I'm a bit perplexed by its strength given the levels of stimulus and debt that have been mounting along with the stresses that real economies face worldwide. Is this a symptom of a forward-looking market that somehow sees real growth in sectors or industries that use the metal?
So it's both supply and demand. So, for example, we had some supply reductions happen, during this year, both due to some worker protests as well as some mine closures around, the virus itself. And so, in addition to demand having collapsed earlier this year, we also had that supply come down. And then as we've kind of pulled into later this year, Asia has rebounded in some ways stronger. And so many of them, for one reason or another, they've had a lot of pandemics in the past. And so they're kind of able to find the right balance there between telling people they can't work versus having it not spread a lot. So they've actually in many cases been able to stay open while also minimizing unnecessary levels of virus spreading just by kind of rational behavior. And so we still do see, for example, strong demand out of Asia for copper, and that's actually been kind of the center of demand for copper over this decade. It's not the United States so much anymore. It's China and more broadly Asia. And so in addition, several years ago we had somewhat of a copper surplus. So they poured a lot of money into finding copper. They found a decent amount of it, and we've had a lot of development happen during when copper prices were higher. But because we've been in a kind of a multi-year bear market of copper, we've not had a lot of new copper supply come online, and so that the market is somewhat tighter than it was several years ago.
Okay. If you mentioned earlier gold in passing, and I think we need to talk about that because of this whole tieback with dollar substitutes. As you bring up the weakness that you foresee going forward in currencies, currency debasement, currency inflating as a tool to help reduce the impact of the debts and so on. I guess, if you could just first talk to us about precious metals in general, what you see the behavior of central banks being relative to those in different countries, and what role you believe that will play at the sovereign nation level, and then how you see it affecting people at their individual family levels of reducing risk from this currency devaluation that you've been talking about.
Sure. Yeah, I turned bullish on them in 2018 because that's when we started to get a reduction in GDP growth and we started to get a reduction in real yields. And so that's when I shifted bullish towards gold and silver. And for the first couple of years of that, into the March of this year, gold outperformed silver, and then coming out of that kind of big deflationary shock, silver outperformed and kind of caught up a little bit. And so we're getting somewhat of a pullback in recent months because we had a kind of a flat line in negative real yields. So from 2018 all the way to August of 2020. We had this significant reduction in real yields as I specified how they're measured. And so they got down to about negative 1%. And then they kind of rebounded a little bit, mainly because we've had treasury yields move up. So inflation expectations have remained relatively flat while nominal yields moved up. And so even though real interest rates are still negative, they're just less negative than they were in August. So in rate of change terms, gold had a little bit of a correction here, and so did silver. Meanwhile, we've seen kind of strength out of copper and platinum and things like that. So that's one of the reasons I like to have a diverse set of metal exposure rather than concentrating too much on any one metal. But over the multi-year long term, I expect interest rates to spend most of their time negative. And so I continue to view precious metals in many ways as a better holding in a portfolio than bonds, for example. So if someone has, say, equities and bonds in their portfolio, taking a chunk of the bond exposure and putting it into some metals exposure can be a way to diversify the risk profile so that they're somewhat protected in the event of a currency devaluation. And then at the sovereign level, we have seen, for example, over the past several years, we've seen a lot less treasury purchases from foreign central banks. And so we've still seen a little bit of demand from the private sector foreign segment, but a lot less so from official central banks. And instead, many of them have either just not grown their reserves, or some of them, like Russia, have grown their gold reserves pretty aggressively. And so the advantage there is that it's sanction proof, it's inflation hedged, it's basically neutral money. It's not tied to any one other country's currency. And so it's kind of like an open-ended option. Whatever the next global financial system is, whether it's that great reset centralized scenario, or if it's just a kind of a decentralized kind of a more organic transition towards different sorts of reserve assets, having that kind of neutral scarce inflation adjusted asset gives them kind of a defense. And so, for example, Russia and some of the other Asian and Eurasian countries have kind of some of them have moved their gold reserves back to their own country, and other ones have increased their gold reserves.
So over the past decade and several conferences that I've attended, there's been a lively discussion about cryptocurrencies and their role as a dollar alternative like precious metals that you just described. Sometimes that discussion has been somewhat, I guess, contentious, saying it's got to be either or. Some people have taken a different approach, saying these are both valid dollar alternatives and people should probably be considering both. Most recently, in the past week, we've heard multiple very high-profile sources saying, cryptos and Bitcoin are this is gold 2.0. It's the new gold. So just as we've seen in the past, when you mentioned several, like in the 70s or in the .com and so on, when they said, new paradigm, everything has changed here. Do you believe from your research that Bitcoin or cryptos in general are really, that everything really has changed? Or do you see them, perhaps cryptos, playing a role in parallel with precious metals as a dollar alternative, as a fiat alternative going forward?
I continue to view it as a parallel thing. And so with Bitcoin specifically, I covered it in 2017 when we had that big run up. And so I took no position. I kind of, my view at the time was that it's an interesting asset, but we still have to watch it. And there was a lot of euphoric sentiment about it. And so you got that blow off top like a month and a half later, and then it crashed, and it's been in this multi-year consolidation. But in early this year, in April, I became bullish on it. So I started incorporating a percentage of Bitcoin into some of my portfolios alongside gold, silver, equities, things like that. And so, Bitcoin and gold, in many ways, they benefit from the same forces because they're both scarce assets. Gold, of course, is scarce due to it's an element, so it's extraordinarily rare in nature, and it's got very good properties for money. Bitcoin, one of the issues with cryptocurrencies is that, of course, anyone can make a cryptocurrency now. Ever since the creator of Bitcoin discovered how to do it, there's been a floodgate of thousands and thousands of cryptocurrencies. But kind of like how, technically we could download everything on Wikipedia and make our own Wikipedia or our own Facebook, right? We could copy it, but we wouldn't get the same sort of traffic there because we haven't built up the same network effect as those other ones. So none of those other cryptocurrencies have been able to rival Bitcoin's network effect. So in terms of the hash rate that protects it from 51% attacks, or from how many different decentralized nodes exist that run the network around the world. So Bitcoin is kind of head and shoulders above all those other cryptocurrencies. So I've taken to view Bitcoin as kind of a highly volatile, kind of a yieldless, scarce asset in a similar way that I view kind of like silver is pretty high volatility. And so I've incorporated that into my kind of a mix of scarce assets. And so I know a lot of people are kind of on one side or the other. So you have like one of the, I think it's Grayscale in the Bitcoin space has kind of run that drop gold advertising campaign. And so they're kind of targeting market share for gold to kind of get some of those investors. On the other hand, you have a lot of prominent gold investors that dismiss Bitcoin as a store of value, and they still emphasize entirely being precious metal focused. Whereas I take some of a mix. I like gold, I like silver, I like platinum, I like copper as an industrial metal, and then I also like Bitcoin specifically within a portfolio.
Well, Lyn, we have more questions, but we are running short on time. And if people want to follow your work and make sure that they stay connected with you, I know you do put out a newsletter. Could you tell people how they can get signed up?
Yeah, so I'm at lynalden.com, and so I have a free newsletter. You can find it right on the homepage there, and that comes out every 6 weeks or so, and just provides a big overview of what's happening in the markets, and also shows a model portfolio.
And folks, please remember, if you haven't done so already, go to libertyandfinance.com, go over on the left-hand side, put your email and sign up for our free newsletter. Comes out 3 times a week, includes the latest videos of all of our guests. We've had more and more people telling us that YouTube is no longer sending out reliably notifications on new video releases. So that's how you're going to find out every single release and get the full description and any links that our guests mentioned. So you don't want to miss out on that. We've been speaking with Lyn Alden, the founder of lynalden.com, this Wednesday, December 2nd, 2020. Lyn, anything that I forgot to ask you or that you'd like to leave with our viewers?
No, I think you pretty much covered it. I think, basically, thanks for having me. One of the ways to kind of defend against kind of multiple outcomes happening. So, no one can really predict the future, what's going to happen 5 years from now, 10 years from now. But basically having some degree of self-sovereignty in your assets is one of the best defenses against that. So it could be, owning scarce things in general. So, in kind of the traditional asset mix, that includes like, equities or especially kind of natural resource focused equities. But one of the advantages of gold, silver, platinum, and Bitcoin is that individuals can also take their own custody of those things and basically, defend that in another way outside of, say, their brokerage account or their other traditional financial account. So having that kind of diverse mix of both assets and custody kind of gives you the most options. So whatever comes down the path, you're pretty well defended from multiple different scenarios.
Well, thank you very much, Lyn, for that final word of perspective, and we just thank you for joining us this first time on Liberty and Finance and Reluctant Preppers.
To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com, Bullion Sales. You'll see my name, Donegan Kaiser, my phone number, and my associate, Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.